Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for Nasdaq ETF's Cabana Week is Bill Housey, managing director of fixed income with First Trust Advisors, to discuss where investors can find some yield in this environment. Bill, it's great to have you with us. Welcome to Trade Talks.
Jill, thank you so much. Happy to be with you.
What should fixed income investors be paying attention to in 2021?
Well, sure. So as we think about what we came into this year with, right, 2020 was the year of withstanding the wildfire. So 2021, I think, is in stark contrast to that. I think 2021 is about an economic recovery and acceleration. And I also think that, one of the key themes this year will be inflation. Right? We have inflation that's probably likely to exceed expectations this year. And if we think about that just in terms of what's driving that, you have major supply chain disruptions that have taken place, right? So if you think about businesses that are selling their goods, they're trying to procure parts for those goods, and that's been very challenging because of COVID-related shutdowns. So that disruption has driven prices higher. But also, you can't ignore commodity prices. You've had a pretty major move in a lot of commodity prices. And if we look at it over the last 6 months, you're hard pressed to not find one that isn't up over 20%. I mean, you can take gold out of the equation, but everything else, by and large, is up more than 20% over the last 6 months. And I think those numbers, as they work their way through, those higher commodity prices probably lead to higher inflation as we work our way through this. And finally, there's just so much liquidity sloshing around. It's a gas can sitting next to the bonfire in terms of what it could lead to as far as higher inflation. But ultimately, it's all going to tie back to interest rates. And we know the Fed has anchored the front end, right? And they're watching the jobs market, they're watching inflation data closely, but the back end of the curve is going to be more free flowing. And so on the back of that growth and inflation that I talked about, and maybe at some point later this year or even early in the following year will be a taper, we think that back end continues to climb. So we think the 10-year Treasury is in a 90 to 140 basis point range right now. And I think 140 will be difficult to break through, but I think as this plays out further, those higher rates on the back end are going to be important to watch.
So, Bill, how concerned should investors be about rising rates?
Well, I think really concerned. I think it's something that, 2020, you had this massive tailwind from falling interest rates benefiting a lot of fixed income investors. So in 2021, I think the game is going to be a lot different. And if you just think about it, we've had incredible duration extension in a lot of major areas of fixed income. And so what's happened is interest rates have come down. Really wise CFOs and CEOs of major corporations have said, hey, issue as much debt as we can, get the lowest rate we can, and extend it as far as you can. And that the impact of that has been lower rates and longer durations. And those long durations mean higher interest rate risk. And so safe fixed income is really not well insulated for a move up in interest rates. Even if you look at, the large investment grade ETF out there, it has a 10-year duration and a 2.3% yield. The AG, which is a third treasuries, mortgages, and corporates, another safe fixed income proxy, is 6.4 years of duration and a 1.2% yield. And this is important because it's just bond math. If rates go up 1%, that duration, you're going to lose that number. So if in the AG, you're going to be down 6.4%, and you can clip that 1.2%. So it doesn't take a lot as far as rate moves now to cause a lot of disruption in fixed income. It's I think, really important.
And Bill, to wrap up here, where can an investor look to get some yield in this environment?
Well, sure. So I think that a lot of the long duration areas are going to face challenges, right? Most bonds are trading at massive premiums, very low yields, very long duration. So one of the areas that we continue to like and have liked coming into this year is below investment grade credit. So if you have an investor that's willing to take some credit risk, we like the bank loan area of the market. It's an area of the market that isn't trading at a premium. It's actually trading at a discount as far as price relative to par. So 97.5 cents is the average price on the index, give or take. But they're floating rate instruments. So while the Fed isn't going to raise the front end, right, as the yield curve steepens, bank loans often are viewed as a safe haven for the higher interest rate environment because they don't have that interest rate risk. With bank loans being floating rate means that you're not going to necessarily face the same challenges that you'd have as rates climb. And we think a lot of these businesses are performing well. The default rate's likely to go lower this year, not higher, on the back of that stronger economy. And all of that plays into our thinking that bank loans could be an appropriate place to allocate some capital in the fixed income market this year.
All right, Bill, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.